This book is a culmination of 15 years of study and industry work, and I was genuinely really proud to have people like Sheikh Yasir Qadi and Sheikh Haytham al-Haddad and my own dear teacher Mufti Faraz Adam say some very nice things about it. And in today's video, I'm going to be summarizing this book for you guys, people who are on the move, so that you can also benefit even if you haven't read it. I want you to walk away from this in just about an hour's time with a really clear game plan on how you're going to make savings every month, how you're going to build your investment objectives so that you're not just stabbing in the dark when it comes to your money, you actually know what you're doing. And also to give you some specific investment platforms out there that you can use today as Muslims to make halal investments. And the goal is that when you walk away from this video today, you'll actually be ready to make your first investments and have a clear investment game plan. For those of you who are new to this channel, I'm Ibrahim, and since 2016, I've helped millions of Muslims with their personal finances and investing. I run Islamic Finance Guru and an investment firm called Curate Capital, and hold qualifications in Islamic law, investment management, and corporate law as well. What we're going to cover is everything from what halal investing even means to why it matters to be investing in a halal way, teaching some of the essential principles of investing, and then covering 22 of the most common halal investment options out there. In fact, this is actually the bit where we'll go much further than the book, as I'll be mentioning the latest investment products that are available today that weren't necessarily even available at the time of the publication of the book. Next, we're going to unpack how you actually build your own portfolio from ground up and cover some real life case studies. By the end of this, inshallah, you'll have a clear roadmap to start or improve your halal investment journey. We will literally build it up for you together over the next hour or so. First off, what exactly is halal investing? So halal simply means permissible in Islam. So halal investing is investing in a way that's permitted by Islamic law. That means we avoid anything that involves riba, which is interest, or excessive uncertainty or gambling, and that's gharar and maisir in Arabic. And we stay away from industries like alcohol or gambling or pork or arms dealing. Think of it a bit like ethical investing, but kind of on steroids. It's not just about doing what's profitable or ethical on its own, it's also doing what's halal and also what's really wholesome. In practice, that means that we won't be investing in things like conventional bank stocks because they deal heavily in interest, or companies that make most of their money from things like, for example, alcohol. We won't be buying standard bonds because those are basically loans with interest baked into them. Instead, we're looking for investments that have halal structures associated with them. Things like buying shares in halal certified companies, or investing in sukuk, which is an Islamic version of a bond, and that completely avoids the interest component associated with it. There are also some finer rules that are involved with Islamic investing, and that's that you're not allowed to, for example, sell something that you don't own, or you're not allowed to have two conflicting contracts in one particular transaction. But I don't want you to necessarily get bogged down in the details of all of that just now. The main idea is keep it Islamically permissible and keep it ethical. And the product or the fund that you happen to be investing in, if it is offered by a specialist Sharia compliant firm, it will actually already have that certification from a Sharia scholar on there as well. In a way, it's a bit like halal food, right? So you've got certain halal food that is labeled halal, for example, meat, because it could either be halal or it could be not halal. But then you don't necessarily see bread that is certified as halal because it's just obviously halal. And similarly, you see investment products like, for example, if you buy a property, it isn't going to be certified halal, it is just halal, right? You're just buying a house. Whereas if you're buying a fund or an ETF or one of those kind of products, you will typically see some kind of certification associated with it. Now, you might be wondering, what is all this fuss about halal investing? Why not just invest like everyone else and then donate the haram part to charity or something? Well, as Muslims, we believe that how we earn and invest our money is just as important as how much we earn as well. We want our income and our wealth to be pure and blessed so that we can have that barakah. The Prophet ﷺ, he taught us that Allah subhanahu wa ta'ala is pure and he accepts only what is pure. So if we knowingly earn through haram means, we're missing out on that blessing in our own wealth. And essentially, it's money that is earned the right way ends up going much further. Really, that's barakah. It benefits you in this world and it benefits you in the akhirah. Another reason why halal investing really matters is frankly purely practical. It's about aligning your money with your values. Halal investing naturally steers you away from a lot of the harmful and exploitative industries that are out there. You're not going to be profiting off cigarettes or casinos or companies that abuse workers or dump toxic waste, because those kinds of companies usually wouldn't pass a halal screen either. And by avoiding interest-based businesses or heavily indebted companies, you're often avoiding entities that actually carry a lot of risk as an investment or that contribute to economic instability. Where there's too much debt, that is actually pretty economically unstable. So halal investing isn't just about the religious rules, it's about aligning your money with your values, and often leads to smarter long-term investment decisions as well. That's why there are many non-Muslims, actually the majority of the investors in the Nest Islamic pension in the UK are non-Muslims. Why? Well, because the halal funds have typically performed better, and they've done so with slightly less risk associated with them as well. Isn't that interesting that Islamic finance and Islamic investing has started to be adopted by both Muslims and non-Muslims? And let's not forget the flip side, folks. If you avoid investing entirely, you say, all right, you know what, I'm not going to be investing because I'm a bit unsure if something is halal. Well, what you're going to do is you're going to keep your money in cash. And the problem with that is that inflation will just eat away at it. If inflation is, for example, 5%, and then each year your £1,000 effectively loses £50 of value if it just sits idle. Islam encourages us to grow our wealth responsibly. We're supposed to take care of our financial well-being so we can take care of our families and our communities. So halal investing matters because it allows us to fulfill that duty to grow our wealth without compromising on our faith. So now that we've covered what halal investing is and why it's so important, let's get into how to actually do it. This is where a lot of people freeze up, but don't worry, we're going to break it down so that you understand it step by step. First, let's talk about some essential investing principles that every beginner should know, especially if you're doing it the halal way. Basic principle number one, get your financial foundations in place. Before you even put a penny into investments, make sure that first of all, you've cleaned up the financial mess that you are in. That means that if you have a high interest debt, for example, a credit card debt or an interest-based loan such as an overdraft, focus on paying that off, because not only is that debt haram due to the interest, it's also going to be charging you way more than you're likely to be earning when you invest. Next, what you need to do is build up an emergency fund. We usually would recommend between 3 to 6 months worth of living expenses in cash set aside in a savings account, ideally a halal savings account. And this is your safety net in case of a job loss or in case of a car breakdown or medical emergencies. Basically, you're not forced to dip into your investments at a bad time. You've got something else to call upon. Along with that, you need to be able to fulfill your immediate obligations. So if you're eligible to pay zakat, which is the annual charity on your sitting savings, make sure that you're calculating and paying that. And while you're sorting all of this out, it's a great idea to actually sort out an Islamic will as well, especially if you've got dependents like kids and you've got significant assets, because we need to figure out where that's going to go if you pass away. At some point, all of us have to do that. And it's also an important part of overall financial planning. The basic point, folks, is that you need to get your house in order when you're about to start investing. Think of it like prepping the ground before you plant the seed. A strong foundation, a nicely furrowed field is going to be a brilliant place to start your investment journey, and it will make it a lot smoother. If you don't put in that hard work, putting in that foundation at the start, then you're going to be building on a pack of cards. Okay, basic principle number 2, know your why. We've got a nice diagram on page 56 of the book where it asks you to fill in a box with 3 questions. The first of those is, why am I investing? The second of those is, what is the amount of money I am aiming to get to? And the third is, what is my risk appetite? The key part of that is knowing your why. It's no good setting off on this investment journey without having a clear end goal in mind. Otherwise, you're just going to meander left, right, and center. You need to understand your why, whether that is saving for retirement, whether that is saving to get down a deposit for your house, whether that is saving up to send your kids to university, whether that is saving to go on Hajj. There are all sorts of things that most people will be aiming for as part of their investment journeys. But you need to understand what is it that you're aiming for. And then once you've identified that goal, that is actually a very, very liberating experience, because now that you've got a goal in mind, you know what timelines are associated with that goal. You know how much risk you can take. For example, if you're investing for your pension and that's in 40 years' time, you can be a lot more risky. But if you're investing for your deposit that you need in 2 months' time, you can't be taking any risks whatsoever, right? So having that goal in mind then actually informs what you're going to be able to do with your money. So before anything else, sit down and answer those 3 questions. Why am I investing? What is the amount of money that I'm aiming to get to? And what is my risk appetite? Basic principle number 3, think long-term and be patient. Investing is not a get-rich-quick scheme, at least not halal investing. It's more of a get-rich slowly but surely scheme. We have an incredibly powerful ally when it comes to investing, and that's called compounding. Basically, the profits that you make, each time you make them, you reinvest those back into the investment. This then generates even more profits and it snowballs over time. So for example, if you started with £1,000 in a fund and it gains 7.5% every single year, which is roughly actually the historical stock market average, 7.5%. By the way, it's also the return we give on our GBP income fund. After the first year, you will have had how much? 1,070. But if you leave that and you gain 7.5% again, you're earning not on £1,000, you're earning on £1,070. So that means instead of gaining £75 next year, you'll be gaining closer to £80 next year, and it keeps on growing. And in 10 years' time, that 7.5% annual growth rate, that £1,000 that you started with, it could have become £3,000. And in 20 years' time, it can become nearly £10,000. That, ladies and gentlemen, is the magic of compounding. Alhamdulillah. But it only works if you're patient and you leave the money that is invested over a long period of time without touching it. Now, long term also means that you mustn't panic when it comes to short-term ups and short-term downs. Markets go up and markets go down, right? That's just what happens with the markets. That is normal. And if one of your investments happens to drop 10% this year, that's not a sign for you to immediately rush to the market and sell everything and hide under a rock. In fact, this could be the single worst decision that you make, because the reality is when markets fall suddenly, that's also then followed in a couple of weeks' time where markets gain very suddenly as well. So if you're sat on the sidelines after panicking and losing a lot of money, you actually are sat on the sidelines at the single best point that you could have had to actually recover your investment to where it was. A recent example of this was when Donald Trump announced his tariffs. Stock markets were really volatile and they plunged enormously. But then within a few weeks, because of Donald Trump being the crazy person that he is and doing unpredictable things, the stock market then actually pretty much went back to where it was within a few weeks. And so as a long-term investor, you need to be thinking in years and decades, not days or months, and certainly not hours and seconds. So the mindset that we have is that we're playing the long game here. Basic principle number 4, understand the risk associated with your investment and make sure you understand this beautiful word called diversification. Every investment that we're making, it carries some risk. And generally speaking, the higher the potential returns, the higher the risk there is as well. A tech startup, it can potentially 500 times the money that you put in. You could put in £1,000, it could come out with £500,000. But at the same time, it's got a high potential of going completely bust as well, and you lose all £1,000. A government sukuk, or an Islamic bond, for example, is very unlikely to default. It's very unlikely that if you put in £1,000, that is going to become zero. But on the other side, it is only going to probably give you a very modest return. So on that £1,000, you might get back £50 per annum. So you're not necessarily going to see the upside in the same way. Lower risk, lower return. The thing that you need to understand is understanding where you sit on the risk spectrum. There are some people who are crazy risky and are happy with that. That is just who they are. Other people are much more cautious with their investments and with their money. And in my time, I've talked to literally thousands of investors, and people are very different. And some people are very risky, some people are middle of the road, and some people are really cautious. You need to understand what your risk appetite actually is for you as a person. And the golden rule to manage risks is diversification. Don't put all of your eggs into one basket. Spread your money out across different type of investments, across different type of platforms, across different countries. That way, if one investment performs badly, others can compensate. Diversification is literally your best friend when it comes to in the investing world. And right now, we are living through the end of an economic cycle where we have more wars in the world, where the US dollar was the reserve currency of the entire world. That's currently under threat, and we are seeing a new world order being shaped with the rise of the BRICS countries like Brazil, Russia, India, and China, and the USA having a bit of a relative decline, the Europeans having a bit of a relative decline. This is a volatile world, and the single best thing that we can be doing with our money when investing through a volatile period is diversification. It just protects you from those surprises. And diversification, it does work actually across many levels, across many asset classes. And so that means you put money into stocks, you might put money into property, you might put money into sukuks, and you spread your risk like that. Then within asset classes themselves, you want to then diversify again. So for example, if you're investing in stocks and shares, you wouldn't just invest in one particular stock, but you would invest in many different stocks across many different industries, across many different countries. Spreading your investments makes you reduce your risk. The idea is that you reduce the impact of one investment if it goes pot, right? That doesn't hurt you anymore as much because it's a tiny sliver of your overall portfolio. It's basically like trying to go on this investment journey, but building in shock absorbers into that investment car that you are driving. Basic principle number 5, do your due diligence or your DD. Especially with halal investings, sometimes you do have to double check if this thing is actually Sharia compliant. And luckily now, alhamdulillah, as I've mentioned, there are many tools and funds out there that do this for you, and we'll touch on more of that later on in this video. But beyond Sharia compliance, just understanding what you're investing in is pretty important. If it's a company, what does this company do? If it's a fund, what is inside this particular fund? If it's a property, where is it? What are the risks? Does it have leverage and bank debt on it? What is it that you are getting into? You don't have to be a Warren Buffett or read 1,000-page annual reports, but don't invest blindly. That isn't you tying your camel as a Muslim. And if you're not necessarily sure about the Sharia aspects of it, consult a reliable source, consult a reliable scholar, and make sure that you've actually got that right. Okay, one more basic principle. Let's call it number 6. Stay disciplined and avoid emotional decisions. I can't stress this point enough. A lot of investing mistakes come from basically two emotions: fear and greed. People panic sell when the markets drop, or they FOMO buy up into hype investments without understanding them because they feel that greed. As a halal investor, you should also avoid the temptation of quick, questionable wins like day trading on margin or risky derivatives or forex, because not only do these things often conflict with the Sharia, for example by involving oneself in interest or gambling like speculation, they're also a fantastic way of you losing money if you don't know what you're doing. So have a plan, which we will build with you in a second, and stick to it. Consistency beats trying to time the market pretty much every time. Alright, so these are our basic principles. We've got the foundations down. Our why is crystal clear in our head. We've got a long-term mindset. We've done our DD, and we now understand our risk appetite. We've adjusted for that, and we're in control of our emotions with a clear game plan and a clear set of rules. Keep those principles in mind throughout. That's probably about 80% of the battle when it comes to investing. Now, let's move on to what people associate with actual investing, which is the exciting bit, exploring the halal investment universe that is available to you. All right, you might be thinking, thanks for this, Ibrahim, those principles are fine, but where do I actually put my money? What can I invest in that's halal? It's a great question. The good news is there's a whole world of halal investments out there. And in this book, we detail a bunch of asset classes and cover their Sharia rulings. But what I'm going to do is I'm going to give you a bit of a handy summary of the main asset classes that we cover. So the first thing that we're going to start with is stocks and shares. This is probably the most common investment that people can think of. Buying stocks means buying the shares of a company. You become a part owner in this company. The first question that you need to ask, however, is, are stocks even halal? And the answer is yes, they can be if a company's business is halal and if it meets the financial requirements that the Islamic scholars have set out. What that means is that, as we have touched upon earlier, a company shouldn't be doing something that is clearly haram. So you shouldn't be investing in a brewery, or you shouldn't be investing in a conventional bank and things like that. And ideally, this company shouldn't have any interest-based debt, or if it does have some, then it should be below the accepted thresholds according to the Sharia standards that are prevalent across the world. And typically what these Sharia standards say is that you're not allowed to have any more than 5% of the revenue of the company coming from haram sources, and that the debt levels of the company should be below 30% of its market value. So for example, you might have a company that's worth £1,000. You can't have more than £300 of that in debt as an equivalent. And if a company is making, let's say, £100 in income, then if it's making any more than £5 in income from a haram source, for example, by selling alcohol, then that would be an impermissible investment in its entirety. We don't want them to be making haram income. We don't want them to have too much exposure to haram debt either. And there are differences of opinion. Different scholars have said different numbers, but the rough ballpark and the rough idea that the Sharia scholars set is that. And the idea behind this ruling that Sharia scholars put forward is that we have relaxed the rules sufficiently such that people can actually make investments. Because if Sharia scholars didn't allow any debt, or they didn't allow any even tiny bit of haram income, then basically the universe of investments would be very, very small, almost negligible. And that would mean that people couldn't really invest their money in the same way that other folks can invest their money. So this is a consensus, or this is an ijtihad of the scholars that we have been following over the last several decades. Now, you might be wondering, do I have to calculate all of these ratios myself? Ibrahim, I have no idea how to do that. Thankfully, no. There are actually Islamic indices like the S&P Sharia or the Dow Jones Islamic Market Index. And you also have screening tools that do all of this number crunching for you so that you don't have to see a financial spreadsheet at all. There are even smartphone apps where you can type in a company name and it tells you yes or no if it is Sharia compliant based on that criteria. Two famous ones that I like are Musaffa and Zoya. These are super handy when you're actually on the go and trying to find if something is halal or not. Additionally, apart from that, you've got these halal mutual funds, or these ETFs, exchange traded funds. And what these are essentially a basket of stocks and shares that a fund manager or an algorithm perhaps has filtered already to be Sharia compliant. And so if you're investing in one of these baskets, you're automatically spreading your money out across all of these different stocks that they've already picked and screened for you. So it's a great option if you're a beginner and you don't necessarily want to get into the weeds of things. It gives you that instant diversification and the peace of mind that someone has thought about the halal side and someone has thought about if this is even a good company to be picking. Now, interestingly, there are a new set of players and a new way of investing in the stock market in a halal way. Two prominent examples of this are Halal Invest and Zoya. And both of these companies, what they allow you to do, they basically plug into your existing stockbroker and they say, look, there might be a really famous fund such as Cathy Wood's ARK fund or whatever other fund out there that is a mainstream fund. It's not an Islamic fund. It will have haram stocks and income in it. What they say is that, look, we've looked at this fund and we we've seen that there's about 100 different companies in there, and we have automatically screened out 40 of them as non-compliant. And then these are the 60 remaining, so you can actually go ahead and kind of replicate that fund by directly investing in those 60 stocks. So that's quite a clever way that these new platforms have come about in giving Muslims at least some level of exposure to some types of mainstream funds. The other really interesting option that has emerged over the last 10 years or so is something called robo-advisors. So what these guys do is they take even the effort of picking the funds out of your hands. There are people like Wahid, there is a company called Sarwa, Simply Ethical, or in America, Sharia Portfolio, Amana, and there's others as well. And what these guys do is that they say, look, tell us what your risk appetite is, tell us how much you want to invest, and then we will go ahead and we will basically create a portfolio of funds for you that are balanced, so that over time, if you're really focused on income, they give you the income, and that, over time, whenever there needs to be a bit of an adjustment made on the underlying fund allocations as well, we will make that all for you. And all you need to do is invest every so often, or invest via some kind of standing order, direct debit kind of arrangement. These robo-advisors do charge an extra fee on top for that service, but for beginners, this is a really compelling option that has emerged over the last several years. Finally, if you are someone who wants to really get into the weeds of things, then there is DIY stock investing for you. And what DIY stock investing basically means is that you go out there and you actually pick the individual stocks, you screen them using a platform like Zoya or Musaffa, and then you decide to invest in that individual stock. Now, you can do that, but bear in mind that that is probably the riskiest way to do stock investing, because you are effectively backing your own judgment when it comes to picking stocks. And that isn't necessarily something that is particularly easy. If it was easy, then everyone would be a millionaire. Now, I should also mention pension funds here. So if you've got a retirement account or a pension fund through your work, it is worth checking if there's a halal option available in that. Many employers in countries like the UK or the USA now offer an Islamic fund among the choices that they have. It might not necessarily be the default choice, so you do have to actively go about choosing it, but by switching, you do ensure that your savings are growing in a halal way. Now, this is something people often overlook to their detriment. So they might be investing their personal money in a halal way, but their pension, for some reason, which is actually a big chunk of their net worth, you might be investing in a completely haram way. So make sure that you do check your pension and that it is actually halal. All right, so stocks and equity funds are one big category that we've covered there. Another big category is called sukuk, and this is often described as Islamic bonds. So in the conventional investing world, when you want to have a steady fixed income, you will invest in a bond, because bonds, they pay out interest, which is a steady return. But of course, in Islamic law, we can't have interest. So sukuks are structured differently. When you buy a sukuk, you're not necessarily lending money to a company or a government for any kind of interest. Instead, what you're buying is a certificate that usually represents some kind of ownership in an asset, an actual thing. And that asset then produces income. For example, it might produce rent, or it might produce profits from the project. And then that income is what you get as an investor. The cash flow, it will feel very similar to a bond, because you're getting a payout every 6 months. And your principal, the initial investment that you made, you will get that back at the end of the sukuk's lifetime. But all of this, the difference is it's being invested and generated in a halal way with real assets at the heart of it, rather than just interest-based lending. Sukuk can be a great option if you want something that's a little bit lower risk, and if you're a little bit more focused on income generation in your portfolio. There are actually sukuk funds out there as well, so that you can buy an entire fund and indirectly hold a whole basket of sukuk for diversification. So some fund manager effectively is managing the sukuks that you're invested into. Similar to sukuk, in the private markets, and basically private markets means everything that is not listed on the stock exchange, you get a whole bunch of other investment options that are very similar to sukuk. So you've got, of course, real estate that you might invest in, and we'll talk a little bit about that later on. But then you have income funds. So income funds are, as the name would suggest, funds that give you a steady income, and underlying it, they are investing in similar stuff, but probably at a smaller scale to what sukuk, for example, are investing into. They might be giving Sharia compliant finance financing, or they might be investing in real estate, things that are giving them a steady return, and then they will manage that and give out their investors a steady return as well. And at Curate, we've got a couple of income funds that we manage. Now, another genre of this kind of investing is peer-to-peer platforms. So these are platforms where you've got people who need money on one side, and they have been due diligenced by the platform, and they offer that to their investors on that platform. And so this includes companies like Nesta or Qardos or Funding Souk, who will connect you up to opportunities that you can then invest into. There are also some Islamic bank savings accounts or term deposits that work kind of like fixed income. So instead of paying a guaranteed interest when you save in a NatWest account or a HSBC account, these Islamic banks, they give you a profit share from their Sharia compliant ventures that that particular bank will be investing into. These are also extremely low risk, but also frankly extremely low return. Think of them basically like an alternative that is for Muslims for savings accounts or fixed deposits that you might want to place within a bank. The return will probably be a few percent a year, not very much, but they can be extremely useful if you just want to park away that money for short-term savings, or you want to park that money in a safe spot just for an emergency fund, for example. But make sure that you don't necessarily park away loads of money in there either, because after inflation, the real growth that you will see in these savings accounts is actually not very big. Still, it is halal, and it is better to keep money in these kind of savings accounts that are with Islamic banks rather than putting it into haram bank accounts and earning haram interest as a result of that. And it's even better than putting your money under a mattress where it loses value every single year as well. Okay, next up we've got real estate. Real estate or property is a tangible and a familiar investment for most people, and it is also generally halal. People, they need homes, and businesses, they need offices. So there's an intrinsic value there, right? All of us are probably sat in a building somewhere right now watching this video, or we can see a building nearby. That is why buildings have so much value, because we use them so regularly. And you can invest in real estate by buying a physical property like a house or apartment or a commercial building and then renting it out, for example. And if you go down this route, then you need to make sure that the financing that you use to buy that house is also halal. So for example, if you're using a mortgage, you need to make sure that it is an Islamic mortgage. The rental income that is coming to you from the tenants is halal, as long as the business that the tenant is running is also halal. So for example, if you rent to a shop that is hopefully not a liquor store, then you will be perfectly fine. But if you rent to a shop that is doing impermissible things, then that starts putting question marks over your income. Now, real estate tends to be a stable, long-term investment. You get regular income through rent, and hopefully the property value grows over time as well. It's not as easily sellable, for example, as stocks or shares. Selling a house does take time. It is less liquid. Managing your own real estate portfolio is actually much harder as well than some might think. It isn't fun dealing with a broken boiler at 1 a.m. in the morning when your tenant calls you, and then you turn up and it turns out the boiler is actually perfectly fine, but they just didn't switch it on. These days, there's also the rise of taxation in certain countries where they are actively targeting landlords. So the returns that maybe were there maybe 10 years ago are just not what they used to be. So make sure you have that in mind when you go into real estate. And the other thing about real estate is that it usually requires a massive amount of money up front relative to other investment categories. But there are now ways around that. And the ways around that are by investing in either listed funds called REITs, so real estate investment trusts. These are funds that effectively pool some real estate together into a listed fund so that you can access it on a stockbroker, and then they give you access to that for as low as £50 or £100. Some REITs are halal because they focus on permissible properties and they use a minimal amount of interest. But investing in a REIT isn't necessarily halal all of the time, because many of them may actually have a lot of debt associated with them. Investing in a REIT, though, it is like a hybrid between investing in stocks and investing in property. You get the diversification and the professional management of a fund, but the underlying assets that you're investing in are still boring properties. Importantly though, you can buy and sell REIT shares on the stock market pretty easily. So it is a more liquid way of investing into real estate. Similarly, there is something called real estate crowdfunding platforms out there as well. And these have emerged in the Muslim fintech space over the last several years. The idea behind these crowdfunding platforms is, for the average investor, they let you chip in together as a crowd. Each person puts in £100, £1,000, £10,000 alongside many other investors, and then together, each of you buy a property together, right? And so you're all in it together and you get your share of the rental profits or the sale profits out of it. It's a pretty cool way actually of investing for people who don't have a huge amount of capital to start with and participate in property with. Just make sure that the platform that you are finding is actually Sharia compliant. Look at how they're actually structuring the deal. Are they using interest? Are they using Islamic contracts like musharaka or wakala contracts to make this halal? It's vital that you do that research before you dive in, because there are P2P platforms out there that are not necessarily Islamic as well. Some examples of property crowdfunding platforms include people like Smart Crowd or Get Stake in the UAE or Yielders in the UK. Now, in a similar vein to property crowdfunding, what happens if you actually do it on a slightly larger scale and you combine the choosing of individual properties into basically one fund? What you end up with is a private fund. And this is something that we run at Curate Capital, where rather than investing in individual properties, you get the diversification of investing in a basket of real estate, and then the fund manager, in this case Curate, would manage that for you. So this is another option available for you to consider when it comes to real estate investing. Now let's move on to another asset class entirely: investing in businesses themselves directly. This includes investing in businesses that are startups. This includes something called private equity. This includes something called venture capital. All of these things really are fancy ways of basically buying ownership in a business that is not on the public stock market. This could be as simple as investing in your cousin's halal bakery to help her expand, or it could be using a platform, for example Curate or Republic, to buy equity in a promising startup company. I personally, to be honest, love this space. I run a venture fund as well through Curate, and it's because this can be both incredibly rewarding financially, and in terms of impact, it is hugely impactful because you're helping businesses that are trying to basically change the world sometimes grow and prosper, and no one else is able to actually give them that kind of money. Banks certainly are not going to be giving them that money. Of course, it is a high risk investment. Many new businesses do fail and they don't deliver necessarily the massive returns that are promised. But if you diversify by investing in a small amount of many startups, then when one or two of them hit it big, that can actually offset the losses that you suffered almost entirely. And in fact, that is where you get the returns that you want to get out of startup investing. Now, this kind of investing usually does require that you lock in your money for a long while. You can't easily sell your stake in a startup until that company is actually acquired by another company, or that company gets so large that it lists on the stock market. So startup investing isn't for everyone, but for younger investors who are perhaps not necessarily as worried about risk and they have some extra capital, this can be that shoot for the moon kind of bit of the portfolio. Just make sure, like everything else, you are vetting the business for halal compliance. And to be honest, most startups are pretty much compliant out of the box because they are dealing with tech, so they're not necessarily selling anything particularly haram. But make sure that you are thinking about the future as well. Like, is this a company that is going to potentially get into real estate and they might need to take out lending, etc., etc.? Think ahead and make sure that you avoid those kind of companies. Now, another area is called private equity, and this is something that we cover alongside venture capital at Curate as well. And the idea is that there are many different businesses out there, many types of them. There's tech businesses, but then there's also more traditional businesses, bricks and mortar businesses like dental practices or shops or veterinary practices or pharmacies. And these businesses also need financing. However, they're not necessarily out of the park winners, right? A pharmacy isn't going to become an overnight success in the same way that Google became when it first launched. It's a different type of business, and so they need a different type of financing. But private equity is also incredibly lucrative when it's done right, and that is investing in bricks and mortar, more traditional businesses. Now, in terms of places that you can find these kind of private equity or venture capital opportunities, you've got Wahid Ventures, you've got Hassan.vc, and then of course you've got our own Curate Capital. There is actually another way of doing this as well, which is that if you're really into tech and you're really into the tech community, you could potentially come across some opportunities by yourself. So that means that you would then have to start attending events at places like Deen Developers or Muslim Tech Fest or Islamic Makers or Alif in the USA, where there is a melting pot of different founders and investors coming together, pitching and sharing their ideas. And if something catches your eye, you can maybe ask the founder, and then maybe he or she would allow you to invest. DIYing all of this is much harder than investing through someone else, particularly when it comes to investing in businesses and startups, because the due diligence that is required, it is a much higher level than is the case where it comes to investing in real estate, for example. So do make sure that you're getting into this with your eyes wide open if you do DIY this. Okay, don't worry, we're almost through the list of options now. Next on the list, we've got gold and commodities. Gold is often seen as a safe haven asset class. It's been used as money for thousands of years, and so many people hold some gold as a bit of a hedge against inflation or currency devaluation. And gold is halal to invest in, of course, but with a couple of conditions. You see, if you buy physical gold or silver, then you need to do it on a spot transaction. That means you need to immediately make the payment and immediately get that possession. In plain terms, you need to basically pay fully for whatever gold it is that you're buying, and you should take it into your ownership pretty much straight away. So what you couldn't do is you couldn't buy it on margin, or you couldn't buy it with a deferred payment plan. You do need to buy it straight away. It's okay to buy it online because that is deemed to be giving you constructive possession, even if the gold hasn't fully arrived in your hands. There are also gold investment accounts and ETFs that are backed by physical gold. So this is a different way of buying gold where you don't end up with the actual gold in your house. And this can be perfectly fine as well, as long as they are structured right. So for example, there are ETFs like GLD gold, and if you invest in that and it is investing directly in lots of underlying bullion, then that's perfectly fine as an easier way, frankly, of investing into gold. That is a listed fund. That is the equivalent of investing in gold. Now, aside from gold, there are other commodities like oil and wheat that can be invested in as well via commodity funds. But remember that direct trading of these commodities is usually done through instruments called futures and options, and that is typically seen as problematic Islamically because of the leverage associated with it, and because of the deferred terms, and because of some of the other more technical issues to do with Islamic law. So I'd say for most people that if you do want commodity exposure, stick to gold and silver and invest in it in a straightforward way, either directly or by investing in through some kind of ETF. Now, some folks may also be investing in something called alternative assets, things like art or collectibles or vintage cars. These can actually be perfectly halal. Again, it depends on what the art is, right? For example, if it's idolatry or if it's nude paintings, then that's probably not okay. But it is a pretty niche area of investment. The value can be very subjective. I mean, why is a painting worth £1 million and another one is worth £2? So unless you're really knowledgeable about these areas or really passionate about them, then you probably shouldn't be making huge amounts of your portfolio these kind of investments, especially for a beginner. But it is good to know that basically anything that has value and that isn't haram in and of itself could actually be an investment. You could be investing in an antique bed, for example. You could be investing in furniture, right? Anything can be an investment if you hold it and it potentially holds its value and increases in its value over time. Okay, finally, let's talk about cryptocurrency. Crypto is a new and sometimes controversial asset class. Now, the big question is Bitcoin halal? That is the main cryptocurrency out there, and it's a hotly debated topic. And without necessarily diving into all the fatwa and making this a fatwa session, here's a really simplified take with that. Many scholars have now said that major cryptocurrencies like Bitcoin and Ethereum are permissible to invest in, considering them to be digital assets, as long as they are not being used for illegal activities or anything haram. They basically say that it's like owning a digital asset. Other scholars, they're not necessarily as comfortable with this analysis. They don't like crypto, and they will cite its speculative nature and its lack of intrinsic value. There's no unanimous verdict within within the scholarly community, but the trend very much seems to be a growing acceptance with caution of cryptocurrency. From, I guess, a practical perspective, if you do decide to invest in crypto, then you should do it with money that you can actually afford to lose. Because you see, it is an extremely volatile investment. And the other thing that you should do is you should screen it from an Islamic perspective, because not all cryptocurrencies are actually going to be permissible. Sure, some of the big ones are obviously permissible, but for some of the smaller ones, you need to actually get into the tokenomics and how the structure of the entire crypto universe around it works in order to figure out if it's halal or not. We do have a list of halal cryptos on our website on Islamic Finance Guru, so you can check that out. And if it is not on there, then I'm afraid you're going to have to do the research and analysis yourself and perhaps ask an Islamic scholar. The other tip that I would give you is try and avoid getting into some really shady altcoins and jumping into interest-based lending platforms in cryptocurrency, because there are actually platforms in the crypto world that would happily give you an interest-based return on crypto deposits. So I would avoid these things. That is not to be confused with something called staking, which is an entirely separate thing. And there are videos that we've done about this, so you can check those out. Now, for me, crypto can and probably should be a small part of a halal portfolio for diversification purposes and for high growth potential, particularly owning Bitcoin. But it's definitely not necessarily a must-have in my view. But I do think it is something good, and you can be a perfectly successful halal investor with some Bitcoin and without some Bitcoin as well. But if you do decide to invest in crypto, make sure that you are treating it as kind of like how you would treat venture capital or startup investing. High risk with a possibility of an incredibly high reward, long-term time conviction, and definitely check the halal aspects of it if it's a specific project that is doing anything that is vaguely a little bit of a gray area. Woo. So we've listed a lot of stuff there. We've listed stocks, funds, sukuks, savings accounts, real estate, REITs, crowdfunding, startups, gold, crypto, and much, much more. The beautiful thing is you can now mix and match these investment ingredients to suit your goals. Halal investment is a bit like a buffet. You need to pick and choose what works for you and what you have the taste for. Some people, they'll stick to stocks and maybe a little bit of property. Others will dabble in a little bit of everything. It's your call ultimately. And as long as you are comfortable with it, and as long as it's halal, no issues. And remember, you don't have to be an expert in all of these at the same time. Maybe start with one or two of these areas that you're most comfortable with. And for many people, that might be investing in an Islamic savings account, or investing in an income fund, or investing in a stocks fund. Something simple and easy to understand. And then once you've done that, you expand as you learn more about investing. Now, how do we put all of this information together? This is where portfolio construction comes in. Basically, deciding how much to put in to each of these categories that we've covered. There's this concept out there called asset allocation, which is just a fancy way to say spread your money across different asset classes according to a plan, right? And your plan should reflect your risk tolerance, your time horizons, and your goals. So for example, let's say you're young and you're pretty okay with risk because you don't need this money for decades. You might allocate a large chunk of your money to stocks and maybe some higher risk stuff like startups or private equity or crypto. Now let's say you're a little bit older, or you might just be a lot more risk averse. You might lean instead towards sukuk, towards property, and maybe only a tiny portion in stocks and maybe crypto. Now, in addition to all of this, there's a formal theory called modern portfolio theory, and that actually helps explain how mixing asset classes together can actually give you a better risk-return trade-off. Basically, not putting all of your money into the single highest returning asset class, but mixing your money with some lower return, some lower risk asset classes can actually make your overall outcome much more stable without sacrificing too much of the return on the upside. The takeaway basically is it's good to have a nice mix and balance between risk and reward throughout your portfolio. In my book, I actually give some examples of some sample portfolios. For instance, you've got a conservative portfolio that might be something like 20% equity, 50% sukuk and cash, 20% property, and 10% gold. A more moderate portfolio might look like 50% equity, 20% sukuk, 20% property, and then 10% of other things like, for example, gold or a bit of crypto. Then you might have a really aggressive portfolio that might be 70% equities and private equity and venture capital, and then the rest of it would be a mixture of property and fixed income, for example. Now, these are just examples, they're not prescriptions. The right mix for you depends on your particular situation. And to help you work your thing out for your own particular situation, let's give you a few scenarios to chew over, and I'm also going to give you a tool, an investment portfolio generator that I'm going to give you a link to in the description below. We'll get to that. All right, let's bring this to life with some examples. I always find that case studies make things a little bit more concrete for people. We're going to look at 3 hypothetical investors, and maybe you can see some of these investors will relate to you and your situation probably a little bit more than some of the other ones. We'll call them Hassan, Aisha, and Omar. Hassan is 60 years old and he's looking to retire in the next 5 years. He might be your dad, for example, or he might be a grandparent. He has a decent pot of savings and a pension that is on the way as well. His main goal is capital preservation and generating some income to support his retirement. Hassan is a conservative investor. He doesn't want to lose money. So what might Hassan's portfolio look like? Well, Hassan might keep only say 20% of his money in stocks and shares or in private equity, and these would be, even there, he would be looking to invest in lower risk stocks and shares and lower risk, more stable private equity. So the stocks would be perhaps dividend paying stocks, or he might be investing into an Islamic fund that has really large cap equities that won't necessarily get too unstable, nothing too volatile. Now let's say another 50% of his portfolio is going to be in sukuk and Islamic fixed income funds to give him that regular payout through the profits at minimal risk. The next 20% of his portfolio is going to be in real estate. Perhaps he's part of a property fund or a REIT, and that gives him some rental income and inflation protection over time as well. And then the last 10% that he holds, that will be in cash or something called near cash instruments, which would be maybe an Islamic savings account deposit or perhaps even some gold. That cash is just there in case he needs it urgently, or if the markets start dropping and he wants to deploy a little bit more opportunistically, let's say, right? If something comes up and he needs to pull the cash to make that investment. This way, if the stock market crashes, only a fifth of his money is actually affected at all by that. The rest of it, 80% of it, is pretty stable. The sukuk, the cash, the property is pretty steady. So his retirement plans, because he's actually now dependent on this investment to give him an income, they're not derailed as a result of this. So this is not a portfolio that's going to double overnight, but that's not his goal. It's about preserving what he has built up and not taking big hits along the way. Hassan is going to be using his portfolio to generate income, whether that's the sukuk that pay the profits, the rental assets that pay the rent, the dividend stocks that pay the dividends. These are all ways that you can help supplement your pension income through investment income as well. And of course, everything is Sharia compliant. So he feels comfortable that he's not dealing with riba or anything haram as he transitions to living off entirely just his investments. Now, Aisha is 35 years old. She's working as a professional and has a long-term mindset. But also, she has medium-term goals, like maybe buying a bigger house in 5 to 7 years, or funding her kids' education in 10 to 15 years. She is extremely balanced. She's very moderate in her risk tolerance. She's okay with some ups and some downs, but not wanting a roller coaster. How should Aisha invest her money? Well, Aisha will end up with pretty much a very middle of the road portfolio. She'll probably put about 50 to 60% in equity funds and stocks and shares, maybe a little bit of private equity in there as well to just give her that growth. But then within that, maybe she might mix in some high growth stocks and a few stable blue chip companies to kind of balance out the growth and also the less risky end of the spectrum. And she'll probably do it just investing into pretty large Islamic index funds and ETFs. She'll probably just do that, keep it simple. And then she could have around 20% in sukuk. So 20% of her portfolio she might put into sukuk or income funds for that stability and for that something that is there to rebalance from in case that stocks do drop. Next, she might look at about 15 to 20% of the portfolio for real estate, so actually investing in property. And that could be that she eventually plans to buy a rental property by herself. Or if she wants to, she can just stick with investing in REITs or property funds, and that might be perfectly sufficient for her. She might also keep about 5 to 10% in cash or gold, again, as a bit of a safety buffer in case something happens or in case she might want to jump in and make a particular investment quickly. And if she's interested and has that knowledge, she could also decide to allocate a small portion, like 5% say, to higher risk venture opportunities or higher risk crypto opportunities. And the idea there is it would add a little bit of spice to the overall returns, but that's totally optional, frankly. In doing this, Aisha's portfolio is pretty mixed. It's not too hot, it's not too cold. And if the stock market has a bad year, her sukuk and other assets probably cushion that fall. And if the stock markets do great, she benefits and she's not too worried about some of the other investments not necessarily doing as well, because that's what they're for. She periodically adds to her investments as well from her salary, and she will rebalance that annually. So if something has become a lot more as a percentage of her overall portfolio, she might just sell some of that, trim it down and put it into some other portion of her portfolio as well. She also makes sure that any new money that she invests follows the plan that she has set. So for example, if she gets a bonus, she doesn't just buy one stock with it. She splits it according to her target allocations, all of the different percentages we've just rattled off, and she might top up certain categories that are lagging behind where they should be. Now, one more important note, Aisha is also thinking about her specific goals. For example, her house down payment. So for that, what she does is she actually keeps that portion of her savings completely separate from her main portfolio. Maybe it might be put in a very safe Islamic bank account or a short-term sukuk fund, because she knows she wants to use this money in a few years' time, and she can't really risk that money too much, because she can't really have that money go down 10, 20, 30%, because then she won't be able to put down the deposit to buy a house. Meanwhile, her retirement and general long-term investments are in the more mixed portfolio that we described, because she isn't going to be needing those anytime soon. So folks, you can actually have different buckets of money for different goals with different strategies. That's perfectly fine to do that. Finally, we've got Umar, who's 25. He's just a couple of years into his career, young, carefree. He's got a small amount of savings and a lot of time ahead of him. And he's willing to take on a lot more risk because he doesn't need this money for decades probably. Umar is more of an aggressive investor. He's aiming for growth. He wants to get rich relatively quickly. Umar might do something like 70% into equities and private equity and venture capital. He might be investing in individual stocks as well because he likes their specific potential for high growth. For example, he might invest in a tech stock that has recently listed and IPO'd because he thinks that that's going to have a lot more potential to it over the next few years. He might decide to put 10% into more speculative, really high risk stuff such as cryptocurrencies. For example, he buys Bitcoin, Ethereum, understanding that this is going to be volatile, and he puts 5% into startup equity investing via certain crowdfunding platforms. These are moonshot investments. They could multiply his money, or they could also go to zero, and he's okay with that because it's a small slice. The remaining 20% of the portfolio, he's decided that he wants a little bit of stability and diversification in it. So he might split that between sukuk funds and perhaps real estate. This way, he's got a little bit of a toe in the more stable stuff as well. He's starting to learn about how that asset class works. But the majority of his portfolio, as you can see, is in growth assets. The sensible growth assets, such as stocks and shares and private equity, and the more higher risk, aggressive growth assets, such as crypto and venture capital as well. In a good year, Umar's portfolio might shoot up quite impressively because that's what a heavy growth portfolio looks like. But in a bad year, it could drop quite significantly as well. But Umar, thankfully, isn't sweating the short-term drops because he's focused on that long-term. That's why he's investing the way he is. In fact, he keeps investing regularly. Every month, a chunk of his paycheck goes into his investment account. And if prices drop, he sees this as a buying opportunity for someone in his 20s. Over time, now as Umar is getting older and once he accumulates a bigger pot that he really wants to start now defending, he might shift his investment strategy to become a little bit more moderate, like Aisha, right? He might trim down that high risk stuff and start migrating more into the medium risk and the lower risk stuff. But for now, he rides the waves, all of course within the purview of Islamic law. So folks, there we have 3 different portfolios matching 3 different profiles. You might find a little bit of yourself reflected in one of those portfolios. Maybe a mixture of a couple of those are what appeal to you. The idea behind illustrating these examples is to give you a sense of how you can tailor your halal portfolio to your particular needs. And remember, this stuff is not static. You can adjust things to your circumstances as things change. And you might be somewhere in between, right? And over time, you might shift between aggressive and conservative as you get older or once you've hit certain key goals. The key takeaway really is that there's no one size fits all, but there is a size that fits you, and you have to find it. We've created a helpful quiz, the link is in the description below, that you can actually take, that will take the answers that you've put in and it will use that to spit out an example portfolio for you to take a look at based on the answers that you've given. Of course, it's not financial advice, it's a tool, but it will give you another way of thinking about what your portfolio can and should look like. Another really important part of all of this is rebalancing. Over time, as your investment gains or loses, your allocation will drift away from what you started with. So maybe your stocks grow so large that it becomes 60% of your portfolio, whereas you intended it to be 50% of your portfolio. Rebalancing basically means that you adjust back to your targets. So either you might sell a bit of the stocks, or you might put the new money that you're putting into your portfolio into other asset classes so that over time stocks comes back down to 50% again. Typically what you might do is you might check in once or twice a year and rebalance if things are slightly off by more than a few percentage points. It's a really good habit because it enforces discipline and it makes you sell a bit of what's high and buy a little bit of what's low, which is logically sound, and emotionally it's hard to do that unless you actually have a particular rule there that you are living your investment life according to. Now, I also want to touch a little bit on tax efficiency as well at this point. Depending on where you live, there might actually be ways for you to invest that give you really significant tax breaks. Like in the UK, for example, we've got the individual savings account, or ISA, which allows you to invest tax-free £20,000 a year for any individual above the age of 18, and all of that money grows in that pot completely tax-free. Similarly, in the USA, you've got the 401ks and the Roth IRAs, and in Canada, you've got similar schemes, and also in Europe. Always try to use these schemes if they are available, because paying less tax legally means more of your money is going to be compounding, and there is an incredible benefit from that. Like the 7.5% that is tax-free is the same as around 13 or so percent that is taxed in the UK. So you can gain very, very significant percentage points as a result of just not paying any tax by using these tax schemes. And it's not un-Islamic, of course it's not. All it is smart financial planning, and the government have facilitated this for you by offering these kind of products. The less you legally owe in tax, the more you can keep and grow for yourself, and also eventually the more zakat that you can pay on it, and the more charity that you can get rewarded for as well. So it benefits everyone. We've covered a lot of ground, folks. We've covered what halal investing is, why it matters. We've covered basic principles of investing. We've covered a bunch of the major investment options that you have ahead of you. And then we've understood how you build a portfolio, and we've been inspired by some example investors who may or may not be in the time of life that we are. Now, to wrap up, I want to leave you with a few final thoughts. The first thought is take action. Even if it is small, it's easy to watch or read and say, oh, that sounds good, but then do basically nothing. The real benefit comes if you actually start investing. So make a plan and take a step this week, today. Whether that's opening an investment account, on transferring £50 into it, or picking a fund to buy, starting is half the battle. And don't be scared. If you've done the basics, if it is halal, bismillah, just go for it. You can only start somewhere, right? And nobody says to you that you have to invest thousands of pounds right away. Even small amounts will teach you a lot. The second final thought is stay educated and surround yourself with the right resources and also the right people. The investment world is always evolving. New opportunities, new regulation, new tax laws, everything is changing regularly. Continue learning. You've got people like us, Islamic Finance Guru, and other platforms out there that regularly publish articles and videos and courses. Make use of them. There are books, of course, this is a shameless plug, such as mine. You've got podcasts like ours and others out there, and you've got entire communities of investors out there. So if you're ever unsure about something's permissibility, ask someone knowledgeable, right? Check a reliable fatwa website. This is an ongoing journey, but you're not alone. There are many thousands of people out there like you, many others who've been on the same path, and we can all help each other learn on this journey as well. My third final thought is be patient and trust the process. As a Muslim, you need to tie your camel and trust in Allah. That means you do your due diligence, make your investments in a halal way, and then have that tawakkul that the outcome is in Allah's hand. If you see setbacks, don't be discouraged. Every investment has ups and downs, right? It's just life. But the general trend, if you're doing things wisely, is upwards over the long run. And there is barakah in wealth that is earned and invested righteously. And on a similar vein, folks, remember to purify your wealth. If there is any non-compliant income that has sneaked in, make sure that you give that away to charity. And of course, pay zakat on your investments on an annual basis, because that keeps your wealth clean, it keeps your wealth pure, and it keeps it growing in a way that has barakah and blessing in it from Allah subhanahu wa ta'ala. Now let's outline a few action steps to concretely get you moving. Action step number 1, open a halal investment account. If you don't already have a brokerage or an investment account, find one that suits you and open it. For people, that could be a stocks and shares ISA with a halal provider in the UK, Wahid Invest, Simply Ethical, Curate Capital, our own fund, or any standard brokerage account where you can plan to pick some halal investments, or even a robo-advisor that has a halal portfolio option. The key is to have that container, that product, that vehicle ready to receive the money in so that you can start investing. And remember, the process is actually pretty straightforward and is all online these days. Second step, start with one investment. Pick something simple to begin with. It could be as straightforward as putting some money into a halal index fund. For example, an Islamic global equity index. Or you might buy a small amount of a stock that you believe in and that you have checked that it is halal. Or maybe it's a sukuk fund if you're very conservative. The goal here is to just wet your feet. Think of this as your trial run. You learn just so much by making that first investment. How the platform works, how it feels to see your investments fluctuate a bit, how fees work. The third action that I want you to do is set up a routine. Decide how often and how much you will invest going forwards. A common approach that many do is to invest a fixed amount out of every paycheck. This is often called dollar cost averaging or pound cost averaging in the UK. It essentially takes the guesswork out of trying to time the market. For instance, commit to investing, say, £200 every month into your chosen assets. Automate it if possible. Direct debit, standing orders. This habit will build your portfolio over time without you even having to think about it every single time. The third action that I want you to do, adjust. Keep a simple spreadsheet or using an app, track your investments, review them every quarter or so, and see if your allocation is still on track or if you need to rebalance. See how they're performing as well, or if something has car crashed or something is really popping. More importantly, review how you are feeling about your strategy. If you find that you're losing sleep over your crypto portion, then maybe you should reduce it. If you feel that you could take a bit more risk for a higher return, maybe increase your private equity or stocks or venture capital exposure. It's your personal journey. The key is to stick to principles, but also adapt the specifics to what works for you. Celebrate the milestones. The first time your portfolio hits a certain value, for example, celebrate that. It's motivating to see. Share it with your friends and family. So, folks, to conclude, remember, halal investing is a means, it's not an end. The end goal is to achieve financial security and growth in a way that's pleasing to our Creator and beneficial to our lives. It is totally possible, as we've discussed, and honestly, it's rewarding when it's done right. There's a special kind of satisfaction in seeing your wealth grow and knowing that it's all clean and it's all permissible. I want that for you, and I hope that this guide, this video, has helped you get closer to that point. If you've learned something new, give this video a like. Consider sharing it with your friends or your family who you think could benefit. And of course, if you do have more questions or you want more details on anything I've touched upon, do drop a comment below. I do read them and I will respond to as many as I can. Or check out Islamic Finance Guru for more resources on some of the answers as well. Don't forget to subscribe to the channel for more content on halal investing and personal finance as well. Until next time, Assalamu alaikum wa rahmatullahi wa barakatuh.